Jenny, take us through Franklin Templeton today. It's a different company today than it was 20, 30 years ago.
Yeah, so we're now $1.6 trillion asset manager. What hasn't changed is we've been very global for a long time. We have clients in 160 countries. But we used to be just traditional asset management. Now we're half institutional, half wealth channel. And we are a top 10 alternatives manager. So we've got, secondary private equity, real estate, private credit, venture. So we've had to evolve as the business has evolved.
You had a strong background in mutual funds. How much of your business is still in mutual funds?
It's still a significant portion in mutual funds. I would say it's probably 900 billion of the 1.6 trillion is mutual funds, maybe even a little bit more than that.
And tell us about alternatives. I mean, there's a lot of talk about private credit. By the way, real estate as well. Where particularly are you in alternatives right now?
So one, private credit, we have about 78 billion in private credit. And it's interesting because a lot of people worry about the growth in private credit, but I think what they miss is banks are just, the capital requirements around banks has changed so much that they're not lending like they used to. And so really that's shifted into the private credit market. And today, if you can withstand the illiquidity nature of the investment, high yield, you can maybe get 7.5%, 8%. Private credit, you can get 12%. That's a big difference in returns. It's just that you're not going to be able to get your money back for, 5+ years, probably.
One of the things that's said about a lot of private credit is a maturity match. So basically, you have access to the capital for a period of time, unlike, for example, a traditional bank, which is deposit-oriented. What is your maturity match like?
Well, when you raise a fund, you tell your fund holders, look, this is probably the length of this fund. And so you really try to match it to that. So I think it's just setting expectations. In some ways, it can be harder for a bank because their depositors, as you saw with SVB, right, where 40% of their deposits outflowed in an hour, that's a different thing. In the case of the private credit market, in many ways, it's a better match because they raise the fund and they set expectations at the time you make your investment.
Why do you think private credit is growing the way it is? I mean, initially, I think it was the thought of we need higher returns when basically interest rates were approaching zero and you could tie assets up and get larger returns. Those days are gone now. We're back up to reasonable interest rates.
I think it's two things. I think the growth in private equity, and that's a whole other thing. I think companies are waiting longer to go public. I don't think this is necessarily a good thing. We have half the number of public equity companies that we did a decade ago and 5 times the number of private equity-backed companies. And oftentimes there needs to be debt instruments as those companies are going private or, so there's lending in the private equity acquisition. They want a piece of debt. So that's grown in the private credit. And then, as I mentioned, the capital requirements for banks have been such that it's really hard for banks to lend in the same way that they used to lend. And so they're preserving their capital for just lending to their very best customers. And honestly, the rest are kind of filled in by the private credit market. And you see it post Silicon Valley Bank, where regional banks were the big lenders in real estate. They've now dried up. And so now it's the private credit market that's filling in to do the real estate lending.
Talk a little bit more about the private equity situation. You said it takes longer now than it did before to go public, to have an IPO. Yeah. So it's harder for people who put the money in to get the money out. How is that playing out?
Well, so two different things. So one is, I think companies are choosing to stay private for longer because of, honestly, some of the nature of being a public company. Pressure on quarterly earnings, this kind of short-term mentality around quarterly earnings. In the past, if you went public partly because you needed to monetize some of your original investors. Now, there's a private equity firm that can take out those investors. So a lot of the transactions were done private equity to private equity. So companies can just stay private longer. And in a time like now, where you have great technological innovation going on, and the work that Franklin Templeton's doing in AI and blockchain probably isn't going to pay off for a few years. If you're a public company, it can be hard to make those investments. We still have founders that own a big chunk of stock, so that gives us a little ability to act a little bit more like a private company. But you're going to invest in these things that aren't going to pay off for a couple of years. And that can be hard when people are looking at, are you beating your numbers this quarter? So I think that's a bit of a challenge. And I think that there's, just a variety of reasons people are, with the luxury of staying private, CEOs are choosing to stay private longer. In 2000, the average company went public after 3 years. Now it's anywhere from 9 to 15 years. And 2 times the growth appreciation that used to happen post-IPO is now happening in the private markets.
Well, tell us more about innovation and how it's affecting Franklin Templeton. And let me pick out one thing specific, tokenization. You were early in on tokenization. Tell us where you're using it, how you're using it, why it works.
So first of all, I am a huge fan of blockchain and the technology. And we had the first SEC-approved money market fund, a 40 Act mutual fund. The SEC had us run the shareholder servicing system. We used to run our own in-house. We're one of the few firms that did, and the one that we built on blockchain. So these are the records of the shareholders. And we parallel processed for a period of 6 to 8 months. And we were astonished by how much less costly it was to run it on blockchain. It's a very efficient technology. And we think it's going to open up a lot new investment opportunities. And honestly, eventually, I think ETFs and mutual funds are all going to be on blockchain. There's a huge cost in financial services to reconciling data between systems. And then once you reconcile it within your own firm, you then got to reconcile it with your counterparty. In the case of blockchain, there's only one source of truth. That transaction happens, everybody has the source of truth. And so that drives out a lot of costs. And when you can drive out the friction in a transaction, you can start to invest in new areas. And there's interesting things like, I love to use the example of Rihanna, because Rihanna came out with an NFT that you get like 0.00033% royalty in her song, right? So when Spotify plays a Rihanna song and you own that token, the smart contract can kick off, and the payment mechanism built in blockchain can give you your fractions of a penny and credit. And because you have the token and there's only one source of truth, it can pay you. So now you can start investing in, as just an average Joe investor, you can start investing in different types that we call cultural assets. I think it's just been kind of interesting.
So that's very exciting, and exciting for Franklin Templeton. Do you see any risks about whether the retail investor knows what they're investing in when they buy what is it, 0.003?
0.0033%. So this is hard, and that's why I think the SEC has really struggled on regulating it, because if it's a token in a game and there's some value that we can exchange in the game, should that be a security, right? So there's a lot of areas that are risky, which is why you want good advice if you're investing in the digital asset or the crypto world. But there's also really interesting asset investment opportunities in that space as well. But it is a challenge, and there are definitely things that you can step in on some landmines. So that's why we're an active manager. We do active strategies and investment advice in the digital asset space, because we know there's places where it is not a good place to be.
Generative AI, it's all the talk all around. How is it affecting, or can it affect Franklin Templeton? How do you use it? How do you plan to use it?
So first of all, it's really important. Generative AI is kind of like the kid who gets an A in English and an F in math. Okay, so if you ask it to do a math equation, it doesn't understand numbers. And that's why early on AI, you need to be able to combine multiple models, which is actually not easy technically. It's complicated. We just announced a partnership with Microsoft where we're building what's basically called a sales assistant, but it's including a lot of different AI models that's going to help our distribution folks be better at meeting customer needs. So, but just to your answer, your generative AI, there's some great, if you think about Franklin Templeton, right, we have a portfolio manager that manages assets. We have clients in 160 countries. So think of all those languages. You can feed in a portfolio commentary and have it translated, and then have a video where the AI changes the lips, the intonations, the hand signals, and communicate a story in multiple countries, almost within 24 hours of producing it. So I think now that's also dangerous. People in the news business, I think it's good for Bloomberg because people trust you, but you can create these false videos. But for somebody like us who wants to get a message out in multiple languages, it's actually pretty interesting.
One of the things I have heard about generative AI, it really needs a lot of data to feed on in order to educate itself to get better and more sophisticated. And some of that can be proprietary within an enterprise, like Franklin Templeton. You have a lot of data on a lot of transactions. How do you marry those two? Do you go to an outside source for the AI to work on your data?
No, you can, but one of the most important and the first things that you do is you ring fence your data. The last thing you want to do is train somebody else's model on your own data. That's the real sort of gem there, right, is your own data. So you have to build the technology and the architecture that you ring fence it. And then as you're building models, you just want to make sure when you're training your own model, it's not something that somebody else gets to train. They're not training on your data. So that's really important. And then you can take your model and train it on external data too. So you want both, but that ability to have proprietary data is important. And that's where I think, honestly, large asset managers are going to have an advantage over smaller ones because we have so much proprietary data to be able to train models. And models consume a massive amount of data to be actually fine-tuned.
It must cost a fair amount to invest in this. It's not cheap. It's not free.
It is not cheap. Believe me, data is like the next oil.
But what do you hope to accomplish? Let's assume it works as well as you reasonably could expect. Is it more products? Is it more customers? Is it less expense? What do you get out of it?
So I think the initial things you're going to see are companies, which is often what happens when there's new technology. Companies just optimize what they already do. So for example, we have a bot that we've rolled out on our help desk. And so when somebody does a question, it's now retiring 60% of the queries. It used to be a person who did that, right? So there's going to be efficiencies that are done. But where it gets really interesting is when you can send out a model that's leveraging a bunch of different AI models to go do a query. So imagine a portfolio manager who says, hey, I'm interested. I've been covering this company for this amount of time. I'd love to understand the other companies in the private markets who may compete against this. And imagine if that answer can come back to you really thoroughly developed because AI's gone and it's gone through and looked through all your internal research reports. It's gone to the sell side research reports. It's actually combed through data that's out on social media. It's gone through video data, images, right? All of those require different models to talk to each other, to filter, and then to come to some kind of conclusion. And it'll make an investment person just more efficient and hopefully have more insights. And then imagine customizations for a client. To be able to communicate a client with a much broader picture, really being able to personalize your solution, AI can be very helpful in doing that.